This is the Retirement Key Podcast with Abe Abich, founder of Abich Financial Services.
It's interesting because it's that time of year where you're starting to see the back-to-school TV commercials. And so for this half hour of the program, I actually wanted to do some resetting, some finance. We're going to do some basic finance retirement 101 for the next half hour, Abe. And you actually, before you and I came on the air, we were talking about the work that we're doing here on the radio each week, the information you work to share, in a conversation you were having specifically with somebody in the office about that.
Yeah, basically retirement fundamentals. And, I was talking to one of our clients, a newer client here in the last couple of years. And he's like, one thing I realized about you, Abe, is that you just continue to talk about the same things over and over on your radio show. And what he was meaning was retirement fundamentals. And I said, and then he went into specifics. I said, sometimes I feel like I sound like a broken record. However, I think people need to continue to hear the fundamentals and not chase the, shiny objects out there when it comes to retirement investments and focusing on individual companies and funds and things like that, but looking at the big picture, right? Looking at the forest, not the trees, focusing on the plan. And so when it comes to retirement fundamentals, starting with the basics is key. First off, I think you want to develop a retirement vision. When do you want to retire if you haven't retired? Where do you want to retire? What kind of lifestyle do you want? Where do you want to live? How much income do you think you'll need? Is legacy important to you? Do you want to pass any money on, or you just want to spend it all down? If you're still working, obviously saving as much as you possibly can, taking advantage of tax deferral, compound interest, obviously building a diversified investment portfolio, especially the closer and closer you get to retirement and into retirement. You want a retirement portfolio built for income, built to last, right? With protection and preservation in mind. And that should be a good mix of investments, diversified. Then you want to manage the risk of your diversified portfolio, right? Because we don't want to lose 20, 30, 40% in a year and fall behind and then try to make it up. We want to watch out for market volatility, inflation, longevity, outliving your assets, healthcare, long-term care, sequence of returns. We do talk about these topics every single week, but they're so important. Then taxes, right? So now we got our income figured out. We're retired. We got our investment portfolio. It's diversified. We're managing the risk. Now, what are some other things that can catch us off guard or maybe eat into our life savings and net worth? Taxes, the possibility of taxes going up, or the possibility of you just having more income in retirement than your working career with fewer deductions. Yes, ladies and gentlemen, we see that oftentimes. And you want to build reliable income. You want to have a withdrawal strategy for that reliable income. And then if legacy is important, you want to build that in. Finally, you want to review the plan regularly, right? You don't want to just put it off for a couple of years. Things can change quick. Look at everything happening here in calendar year 2026 internationally. And so you want to make sure that everything going on in the markets and in the economy, that your plan is keeping up with those things. So those are the pillars, and we need to pay attention to them, and we need to focus on them. I would call them 5 pillars right there: income, investments, taxes, healthcare, and estate planning.
Got it.
And if you're building a plan around those 5 pillars, there's not a lot out there that you're not going to plan for when you have those things in mind. So back to the basics. Look, major leaguers do it. Football professionals do it as well. They go back to camp, like a summer camp before the season starts, and they just get out there and they start catching balls and they start running routes again, just like they did when they were 5 years old, if they were playing, and
Little League.
Yeah, right. So I think we should as well as we prepare for retirement.
Something else that I think that you're constantly stressing as well, again, going back to fundamentals and just revisiting those principles over and over again, is the argument that you point out to so many people that chasing the sexy investment, chasing the fancy and fast. For the people that you're talking with every single day at the offices of Abish Financial Services, you're constantly saying, you've won the game. You've made it to retirement. You've got $1 million, $2 million, $5 million saved. Why would you be chasing fancy and fast and risking that when you can live the life you want to live? Why risk messing that up?
I think because the focus, people do that because the focus was on the investments and on the dollar and on the rate of return for so long, right? For 30 to 40 years. And then they get to the point of retirement or early retirement, and a lot of people still have that focus when they're really losing focus of the big picture plan by doing that, right? And then they're scared to spend their money, right? If you're focusing on stocks or just funds and the returns, they're in, maybe the latest fancy investment or whatever company that just IPO'd, and that company goes down, now you don't want to sell it, right? Now you don't want it. So
I think that, but also I would say, the work that we do here, you're hammering these fundamentals in. Maybe you and I we're doing a bad job not doing the sexy headlines. Like a lot of financial news and radio and TV that you see, it is about, the fast and fancy thing, the flashy thing. You and I are over here going, everybody take your money, create reliable income streams, have a boring financial retirement plan so that you can have a fun retirement.
I think boring is actually something to strive for in retirement when it comes to your retirement plan, meaning you don't want a lot of volatility. You want stability. You want a dependable plan, a predictable plan, right? And so that's not going to come by chasing the next headline.
If you believe boring is better, reach out. Abe and his team here to help you build that kind of plan. 571-570-3559. Also online anytime, theretirementkey.com. Let's continue on the point you just made about people that are afraid to spend their money. Even when they've done everything right, they've saved enough. Because an interesting twist of this idea is that the very people who have built significant wealth might be the least likely to ever feel comfortable using it, Abe. This is financial author Adam Grossman recently on Morningstar.
I see the thinking, which is that people shouldn't unnecessarily deprive themselves in retirement after saving their whole lives. They shouldn't have to live on ramen noodles if the numbers say that they really don't have to. But I think that there's a little bit of a conundrum there, which is that people who are frugal by nature are people who will tend to accumulate significant portfolios. And so they're the people who can afford to spend more in retirement, but it's just not in their DNA. So it is harder for those people to spend. Someone's naturally frugal and you tell them, don't buy the Honda, go buy the Mercedes, they may not want to do that.
It's natural frugalness that has been embedded in these strong, smart savers, Abe. So how do you help somebody flip the switch when they've spent a lifetime being careful and now they're being told it's okay to actually enjoy it?
I think number one, having a plan that allows them to do so, right? So turning that accumulation plan and that savings, those dollars into enjoyable income and showing our clients how we can do that, showing them that income is going to be dependable, that they can depend on that income coming from different sources. And then finally, encouraging them to spend. We are a distribution planning firm. That means we help our clients get money out of their accounts so they can enjoy their life savings during retirement. This is why you save that money. A lot of firms don't want you taking money out of those accounts for various reasons. That's because the focus is usually rate of return and growing. Our clients have reached retirement, about to retire. They want to turn the nest egg into enjoyable income. And I've had those conversations with clients, Heather, where I'm like, you know what? Don't be afraid to upgrade those seats to Europe when you go to Italy to first class or to business class. You have the money. You've got millions of dollars here. What else are you going to do with it?
Right.
Don't be afraid to upgrade and stay in a nicer hotel or whatever it is. And they'll look at me like I'm crazy. Like, you're a financial planner. Why are you telling me to do that? I'm like, well, if you don't, you're going to be 80 to 85, maybe wishing that you did. And no one wants to be in that position.
Right.
So we just recently worked with a couple out of Leesburg, Virginia, about $1.5 million saved and accumulated in IRAs predominantly. Late 60s, about a 7 risk on our risk scale of 1 to 10. That's a 70-30 allocation where 70% is set out for growth and 30% is set out for income and safer vehicles, protection in the plan. Problem with them is that they wanted to turn their savings into income. So they had saved $1.5 million looking for an income and a distribution plan. Like, we have this money saved. Now we want to retire. How do we turn it into enjoyable income? By putting together a plan, by looking at how we're going to do this, by putting together a withdrawal strategy, by sticking with the fundamentals, just like professional sports players do. They go back to spring training and their sports headquarters every single year before the season, and they get back to the basics. We're going to do that with a retirement plan. So we put together a retirement income plan for them to show them how to do just that. We show them how to take their savings and turn it into enjoyable income. It's a permission to spend. We talk about this on the show here in the DC metro area. Oftentimes that permission to spend comes from having a plan that you can trust, working with a firm that you can trust, believing in the plan, right? If you're going to a restaurant or a new venue or a new location in the area that you haven't been to for the first time, you're more than likely going to put it into GPS. And oftentimes I'll put a location into GPS when I've been to that location 100 times, just in case there's an
traffic,
accident, right?
Yeah.
And it says, you know what, you should take a detour and then take another road. I don't want to really be thinking about it, especially if I'm on the phone,
especially
right? So I'm going to put it into GPS.
In this part of the state, the traffic that can accumulate, forget about it.
You never know. I'll tell you what,
never know.
just living in the DC metro area, my entire life, like 40 something years, you're bound to expect something, whether it's construction, whether it's a car accident, or just simply rush hour traffic in the morning or after work. But, just like you would put GPS in your car to get you safely to a destination, you want the same thing with retirement. You want GPS for your retirement. You want a plan that's really going to help you to navigate all the ins and outs of it. And for this couple, income was one of the most important things. So we put together a simple but powerful retirement income plan that showed them where the income could come from, that they could follow and track with us 4 times a year in our reviews with them. So if you're listening to this, you're 55 years old and older, you've saved $500,000 or more for your retirement and in investable assets that we can help you to manage. We want to help you to put together your own customized retirement income plan. Turn that accumulation into distribution. Go from the ascent to the descent safely, that retirement mountain we talk about. Put a plan together to enjoy your money. Complimentary.
571-570-3559. Call right now. Let's set a time on the calendar. Start the conversation about your own retirement income plan. Complimentary. 571-570-3559. That's 571-570-3559. Again, we're constantly talking about praising the people here in the DC metro area, all the hard work they've done, the saving, the sacrificing over the years. So many smart DIY investors. They figured they've done it on their own this far, gotten to this point. What's the big deal with DIYing it in my retirement as well? I mean, it can't be that hard, right? Well, these are the kinds of things we like to point out because it's such a different ballgame in this next phase of life. And actually, there was a gentleman, he wrote into a column on MSN.com talking about the story of trying to plan for retirement on his own. And he was pointing out a few major spots that he got wrong himself. He said he had to self-fund his healthcare for 2 years, which was way more expensive than he had thought. He figured Social Security would be enough to handle his monthly expenses. It was not. And his biggest miss was not factoring in unexpected expenses like a house repair, a car repair, a trip. These were all budget busters that forced him to cut back on his lifestyle, which, of course, none of us want to see happen, Abe. So is this something that you see? What do you do when you're planning to help avoid this kind of problem?
Yeah, that is all true. We see that oftentimes as well, Heather. Look, healthcare costs are oftentimes underestimated. Self-funding for health insurance before you can hop on Medicare, far more expensive than a lot of people expect. And planning for that gap is critical to avoid draining savings early in retirement. And it's a conversation we have oftentimes with our clients leading up to Medicare there. Social Security alone hardly ever covers expenses. Many retirees assume their monthly benefit will be enough, but real-life costs, housing, food, discretionary spending often exceed those payments, and advisors should stress building supplemental income streams to fill the gap. Obviously, we do that as well. Typically, our clients have saved a few $1 million, and we can help them enjoy a pretty good income from that life savings amount that they've worked so hard for. Unexpected expenses continue to happen in retirement. They can also derail budgets if you don't have cash flow set aside or cash set aside for emergency funds. So a robust emergency fund and a flexible spending plan can help absorb those shocks without sacrificing your lifestyle. Finally, that would be a good lesson for anyone listening to put together a plan. A comprehensive retirement plan should include all of these things: healthcare projections, realistic income analysis, a contingency for reserves. These steps reduce surprises and will help keep retirees from having to cut back dramatically. At the end of the day, what do we keep on really pointing out on the show over and over and over again? It's a plan. Going back to the basics, and in that plan, covering all your bases as much as possible. It's not just the money. It's not just the dollars. Yeah, that's extremely important. The dollars are going to help you do what you want to do. We want to protect those dollars from all the risks we possibly can that can really erode your wealth and mess up your wealth. We just recently worked with a couple down in Fredericksburg, Virginia. About $1 million to $2 million saved and accumulated. 6 risk on our scale, that classic 60-40 allocation that they're comfortable with. Early to mid 60s. And the problem with their plan and when they came to us is that, the gentleman, the husband, was kind of managing the finances, and he just wanted to get out of his own way and didn't know what he didn't know, right? Yeah. And a lot of people come to our conference room table saying the same thing. Look, I feel like I've got a good amount of money saved here. I don't want to mess this up, right? I want money to go to my wife. I want money to go to my kids, my grandkids. I got to get this money to last me the next 30 years. And, I know a little bit about mutual funds and ETFs and whatever was in my 401k. And, I've got a good idea when I want to turn on Social Security and things like that. But there's so much more to know about a retirement plan. And I think a lot of people realize that, acknowledge that, and because of that, hire a retirement planner to help them. And that was the case with this family and this gentleman who's kind of leading the way with the family finances, wanting to get out of his own way, wanting to enjoy retirement and not worry about their plan, not worry about the stock market, their income, and all these things as much. So the solution was to put together a comprehensive retirement roadmap. We put together a customized retirement roadmap for them, plan for income, a plan for growth potential, a plan for the taxes, the health care, the estate plan, with legacy planning being very important. They had a big family, want to pass on as much money to spouse, kids, grandchildren as possible. If you're 55 years old and older, you've saved $500,000 or more in investable assets that we can help you with. We want to help you put together your own customized retirement roadmap. Put all those things together into one plan, under one roof. Protect your retirement as much as possible. Complimentary.
571-570-3559. That's the number to dial right now. Let's set a time on the calendar. Start the conversation about your own customized retirement roadmap. 571-570-3559. That's the number you're dialing right now. It's 571-570-3559. Something else that we're constantly have to battle off, Abe, is the ongoing headlines, the ideas that other people project upon us, even the rules of old that have worked in the past that are no longer applicable. For decades, retirement came with a predictable playbook. Save consistently, follow a few simple rules. You're going to be okay. But that playbook was built for a different time and a different economy. So today's retirees are dealing with things like longer lifespans. We've got higher inflation. We've got more market volatility. Some of the most trusted retirement rules of the past are not holding up anymore. And I wanted to ask you to go through the ones that you're seeing folks come to you with and asking about that just don't hold up anymore, that we need to look past, find the new rules. What are the new rules of retirement?
Yeah. Good, Heather. Yeah, here are a few. 4%, the 4% withdrawal rule, right? It was meant to be a guide, but never designed to be a true income strategy. You want to know what the 4% rule is. What is it? How does it work? Why would that be important to me? And then develop your own customized income and withdrawal strategy. Your home is your retirement plan, quote unquote. There was a time when people believed their house would take care of them financially in retirement, but with property taxes going up, insurance costs going up, maintenance expenses are making that strategy far less reliable. Many retirees can end up equity rich and cash poor because a home doesn't generate income on its own, right? You got to sell it, you got to refi or whatever to actually use cash in the house if you have it. The market always comes back. Well, over a long period of time, the market wins, right? But what if the markets are down right when you need income in retirement or right when RMDs start or whatever it is? That mindset worked when you were younger and still contributing to the portfolio, but in retirement, you're withdrawing money, taking withdrawals during downturns. Man, that can be a double whammy. We talk about that oftentimes too, sequence risk. I'll add one more.
Yeah.
And that is when you get to retirement, you're going to have lower taxes in retirement simply because your income is lower.
Yeah.
And that might be true for some, but for so many people we meet with, Heather, and we talk about this so often on the show, it's simply not true. Yeah. One of the biggest myths I personally believe about retirement planning is that when you get to retirement, you'll be in a lower tax bracket. So you want to know the rules of the game. You want to be educated, and you want to know how all these things will affect you. We just recently helped a family out of Vienna, about $8 million accumulated. Just wonderful job of saving diligently, prudently, not overspending, obviously, and just being educated, obviously, as well on investing and just retirement. But again, here's a couple with $8 million saved, just kind of getting out of their own way and saying, you know what? I want you guys to take it over. You know why? I want to enjoy my retirement.
Yeah.
And I don't want to be managing this every single day. And I really, really applaud that. And that's what I would want for myself as well. So I can be traveling, doing whatever I'm going to be doing in retirement personally. And so one of the biggest things for them was, with $8 million, and that's just investable assets. That doesn't even include real estate. You're talking over a $10 million net worth.
Wow.
One of the biggest things for people with that kind of money saved is looking for ways, every way possible, to lower taxes on those investable assets, on that wealth, to make those dollars most tax efficient for the family. Well, when you've got large gains in a brokerage account and you've got tons of money saved in pre-taxed accounts, if you let all that continue to compound and grow, you can have massive RMDs, sometimes hundreds of thousands of dollars a year that people oftentimes don't need, that just continue to stack. And even if the tax code never changed, that could end up pushing you up into a higher tax bracket. So we put together a tax mapping report and tax plan for them. Gifting strategies were discussed, RMD strategy, QCDs, Roth conversions, all of it. If you're 55 years old and older, you've saved $500,000 or more for your retirement, we want to help you put together your own customized tax mapping report and analysis with a tax plan to see how we can help you potentially save as much tax as possible and be as tax efficient with your retirement nest egg as possible. Complimentary.
Abe and his team, they are here to help you do that. So it's theretirementkey.com to start the conversation, or you can just click on the links we've got posted in the show notes.
Thanks for listening to the Retirement Key Podcast with Abe Abich. To learn more about Abich Financial Services, visit theretirementkey.com and join Abe for his radio show, The Retirement Key, Saturdays at 8 a.m. and 2 p.m. and Sundays at 8 a.m., 2 p.m., and 5 p.m.
Abich Financial Wealth Management is an SEC registered investment advisor. Registration does not imply a certain level of skill or training, and the SEC has not approved or verified this communication. As a registered investment advisor, we are a fiduciary under federal law and owe our clients duties of care and loyalty. Abich only transacts business in states where it is properly registered or is excluded or exempted from registration requirements. This material is for general informational and educational purposes only and is not individualized investment, legal, or tax advice. Investment advice is provided only after engagement under an appropriate advisory agreement. Structured notes, annuities, Roth conversions, and related strategies involve risks and may not be suitable for all investors. Structured notes may involve issuer credit risk, limited liquidity, capped or conditional returns, loss of principal, and protection features that may not apply in all market conditions. Annuity guarantees depend on the financial strength and claims-paying ability of the issuing insurer and may be subject to caps, restrictions, fees, and surrender charges. Roth conversions are taxable events, and outcomes depend on individual circumstances, future tax rates, and investment performance. Third-party rankings or recognition are not guarantees of future results, endorsements, or representative of any client's experience. Criteria and fee information are available upon request. Any hypothetical or illustrative scenarios referenced in marketing materials are for demonstration purposes only, do not represent actual client experiences or guaranteed outcomes, and should not be relied upon as predictions of future performance. Investors should review all offering documents, understand applicable risks, and consult qualified financial, tax, and legal professionals before acting. Past performance does not guarantee future results. Endorser is not a client, and this testimonial has been compensated. Opinions are their own. Compensation may create a conflict of interest. Testimonials may not be representative and are not a guarantee of future results.